Okay guys, so here we have a short video on how to place orders on the AVATRADE platform. So let's say Eurodollar, you're thinking about buying Eurodollar, you want to buy Eurodollar. So you pop it open, you can buy it by clicking the blue button. But before you buy it, you want to protect yourself with a stop loss and maybe even a take profit. Maybe you want to leave the take profit out and just put in a stop loss. It's always good to have a stop loss on a trade. So this is the current price you can sell at 118.58, 118.59. Current price you can buy at. The difference between the price you can sell at and buy at is called AVA spread or dealer spread, and you can see it goes between, it's about a pip and a half, 1 to 2 pips, which is pretty much normal. And so before you actually buy it or sell it, you want to put in your stop loss as well. So you can do that right here. If you want to put a profit take, you can do that as well. But before we get to that, we got to think about, well, what size of a transaction do we want to do? Right now it's set at 0.1, which is essentially a dollar for each pip. So let's say you want to just trade for $1 a pip to get a feel of this. So right now you see it's trading 59. You look at your little chart, it's coming up a little bit, but you still think you want to be a seller. So you say, okay, I'm going to sell this at about 60. That's where it is now. So I want to put my stop loss, and you just type it in, 118.70. So you want to risk 10 points. So you say sell at market, and boom. So now what we do? We sold it at 60, and we put our stop loss at 70. So the most we're going to lose on a trade is 10 pips at $1 a pip, $10. That's the max we're going to lose on the trade. Now at the moment it shows us as losing $1.20 on the trade. That's our P&L on the trade. It has a minus. And where that's coming from is simply the price we sold it at, 118.60, and the price we can buy it at right now on the platform, which happens to be 59.5. So at the moment we're up 50 cents. We're up a half a pip. And as the price we can buy it at, this what's called the offer price, as that changes, our P&L will constantly change. So as long as the price stays below 118.60, not counting that last digit, which is kind of irrelevant, so 118.60, see now we're a little above 118.60, so we have a slight loss. So there's our trade, and just say okay to click out of that box. So now we're sitting here and we're watching and we're saying okay, and we're okay with the trade. And then all of a sudden we just have a change of heart and we say, you know what, I don't want to be in this trade anymore. So all you do is double click on the trade, and you say, okay, what do I want to do? Market execution. I want to close the trade. You hit this button and boom, your trade is gone. And okay, you closed it at 60.5, so you lost a half a pip. You lost 50 cents. That's it. Now if you did the trade a little bigger, there'd be more money involved. So let's look at a couple more possibilities here. Let's say we're looking to instead of selling it, we're looking to buy it. So if we want to buy it, we have to pay what's called the ask or the offer price, and that'll be a little higher than the price we can sell it at right now. So as soon as we put the trade on, we are going to have a small loss. If the spread, the difference between the buy and sell price, is 1.5 pips, we're going to have a $1.50 loss if we're trading $1 a pip. Now let's say we get brave and we decide to go for $10 a pip. Well, instead of doing 0.1, we would do 1. And if we're going to buy it right now, it's about 62, so we're going to put our stop loss at 52, 10 points lower. So we're going to risk at $10 a point, we're going to be risking 100. So let's go ahead and buy it, and boom, we bought it. Now you see we bought it at 61.8, and the best we can, the price hasn't moved at all, but the best we can sell it at is 60.3 because of the spread. So we're going to be losing $15 because of the spread right away. We need to overcome the spread to start making money. So we say okay. So now we have our open trade. We can see what our P&L is. We know that $15 we paid that for the spread on the trade. The actual price itself has not moved, and now it moved very slightly our favor. Now it's back to where it was. So now we're back to just down 15, which means it's just the spread. So we need this price to get above 61.8 to short sowing a profit. If it goes lower, it went a little bit lower. For each pip it goes lower, one full pip, meaning a full pip would be 118.61.8 to 160, 111.68. That's one pip, and that would be $10. Right now it's not moving much. Let's watch it for a minute or two and see what happens here. Remember, we're not talking about trading here. We're not trying to trade this to make money. We're just trying to learn how to place orders. Well, let's say it's starting to lose money on this and you're getting a little nervous. So you say, okay, I want out of this trade. So you just double click the trade and you say close it, and you're out. Boom, you're out. You're done. You closed it at 61.8. You closed it at 55.9. So you can see it took a real quick drop there. So that actually cost you a couple of pips. If we were just a little bit quicker, we wouldn't have lost much on the trade. Well, let's try another one. Let's try once again. Let's try a sell. So once again, we click on the sell button. If we want to trade for a 10, if we want to go back to $1 a pip, we just go 0.1. If we want to sell or buy, and if we want to put a stop loss or a take profit on the trade, we would put it here. So let's say we're thinking of selling at 57. So we want to. I'm going to put a stop loss at 67, 10 pips. And sell it. Let's say I want to put a profit too, so maybe I'm thinking, okay, this is going to fall. I want to make sure I got my profit in there. 118.50, say we're going to go for a profit. So now we say we want to sell it at the market, which was 57. Our stop loss is at 70, and our take profit is at 50. And again, I'm just looking at these levels, not to so much trading levels, but just to show you how to use the platform. So now you have a trade open. You sold it at 57. If it goes up to 67, you have your stop loss, and you have your take profit at 50. So you're most you're going to lose is 10 pips, and most you're going to make is 7 pips. So if the price reaches 50, you're going on where this side is 50, you're going to hit your profit level, close the trade. If the price reaches 67 on this side, then they're going to take you out of your trade, and you're going to lose the difference between 57 and 67, which is $10, because you're playing for $1 a pip. If you were playing for $10 a pip, it would be $100. That's it. That's how you do orders. You want to close it, you double click the order, or even single click it, and you say close it, and it closes it for you, and that's the end of it. Cost you $1. And you just lost the spread, really. The price didn't really move, but you have that spread, that cost of doing business. So you just have to be careful you don't do that too many times, because each time you are paying an entry fee. You wouldn't go to Disneyland and walk in and buy an ice cream and walk back out after buying a ticket. Hence, when you put a trade on, you should have a reason for putting the trade on, and you want to stay in it for a while and give it a chance to make or lose a little bit of money for you. So, all right, guys, I think that's it. I will speak to you again. Jimmy Young signing off. Bye-bye.